Hello and welcome to the IFA Roundtable series, luckily brought to you as well by Macquarie Professional Series. I wanted to talk about this topic that we're having a conversation around, and I think, to say the least, it does hit home for a lot of people out there, not just advisors, not just clients, and not just the industry. It's global equities. And to start this roundtable, I want to introduce the table here. I have got Carlo Queddeng, who's the head of managed funds at Providence Wealth Advisory Group, and then followed with Luis Sarmiento, who's the division director and our leading investment specialist at Macquarie Professional Series. And then we also have Deborah Harbrow, our private wealth advisor from Lipman Burgon and Partners. And over here, we've got Eugene Ardino, who's the CEO from Lifespan Financial Planning. And last on the table, we also have Brendon Vade, who is advisor at Lorica Partners. Everyone, welcome to the table. Thank you for joining us.
Thanks for having us.
And I think, to say the least, there's been a conversation around, I think, everyone where we're not just looking at what is happening in the market, we're looking at why and how. And I think we've understood that there's inflation rates that have increased, there's raising rates that have increased, and we're kind of in this, I guess, a period of time where, yes, we've seen this before in some degree, but it's also, and I think also, Lewis, we said off air as well, there is an element of, you've seen it before, but there's always a new facet that comes with it, or a caveat, so to speak, within the markets. So I think I want to open this up anyway to the table, whoever you wish, but I wanted to get a bit of an idea towards the human angle and stresses placed on advisors. I also wanted to get a bit of an idea as well, Lewis, potentially from you around what we're seeing from the central banks lifting rates. I think it's really important that we can kind of join those together so that the conversation itself can flow in an equal, balanced way. And I guess it's going to be a robust conversation from there. I think these are really valid points as well. We'll also move into how staying invested in that mentality of, understanding where the risks are, but also understanding how to, like you said as well, Carlo, the preservation of that towards your portfolio and also the diversification, really important things. Just on markets today as well, trying to work out a bit more. Passive investing has been obviously a long-term play for clients, investors, and advisors, I guess, in that moment as well. I wanted to get a bit of an idea towards the active side of things. Are we seeing, and Lewis, I might throw this to you. Are we seeing at the moment that has taken a step up in this sort of status quo of passive investing?
Well, I have to say, the professional series is all about active investing, so I'm probably a little bit biased in my comments. But yeah, we represent 5 what we believe are really high quality active managers. I think probably the interesting thing to highlight is they're all very different. So it's I think that's what makes my role a lot of fun. You can talk to these very much experts in their areas, and you can see how passionate they are about investing, and at the same time you can see how differently they sort of solve that problem of investing, and how high they can be in their conviction of their approach, and again, how different they can be. So, from our perspective, yes, when all boats are rising, when dispersion between different sectors and countries is low, there's going to be less opportunity for active management. And when you have disruption and volatility, like we saw through COVID, and we actually saw that in the numbers as well, and through the recent drawdown in terms of offering defensive outcomes, we have seen many of our managers really well.
And also, I suppose, to the advisor side as well, there's an education point towards active management and passive, depending on how your clients react, how they want to learn or how they want to engage their portfolio. Has that changed in the last few years onto how the benefits of maybe active has changed, or is it vice versa? Has it not had any effect on them at all?
I think it's been a very volatile market over the past 2 years since COVID anyway. We've certainly been more on the active side of fund managers, and we select fund managers based on the merits of the product. Walter Scott, for example, their downside capture over the past, let's call it 20 years, 15 years, has been 65% downside capture and 93% upside capture. Now that's something that you look for in an active manager, in terms of protecting on the downside and receiving most of the upside. Over the long term, you get much more return through an active, even though you're paying fees for it. As I'm a manager and I'm looking at all these different active funds, are you receiving active alpha over the fund manager fees? Is how we look at it.
I think going back to, a risk-off environment where we sit today, how do you manage risk, particularly the way I look at it as well in an active segment? You're going to have that conversation to be able to manage that perhaps a bit better. Am I wrong? Am I right?
If I can say our managers, and the way we pick them actually, they're typically not on the sort of higher octane sort of areas. They tend to be very conservative and stay away from those really hot places. And many of them do shine when markets come down and correct. So we've seen, and in particular over the last 6 months, we saw a lot of the growth managers really hurt, and our quality growth manager, which is what it's got, actually has underperformed the benchmark, but really outperformed all those other competitors that are also in the growth space. But value being in favor, we've seen our value manager, and he's been hurting for 6 years. They deliver very, very strong alpha. Our quality franchise managers deliver strong alpha. So we sort of think that, if you're looking at the advisor market in Australia, you're looking at what, mums and dads are trying to do, which is save for retirement. It makes a lot of sense to have a very professional approach to investing and stay away from maybe, the trendy things that maybe taking off now and again, but having a very sort of solid foundation. And to your point about, it's not just about performance. I think for us, it's very much about true to label and, how to describe their conviction about their approach, and then sort of actually seeing that reflected on the stocks that they're holding over time. And that means that you might need to be patient. For example, with our value manager, you might need to be patient because the style or the type of company they're in might be out of flavor, but over time they should come through.
I think what's been interesting over the last, just say 2 years, this is an important lesson just of how sharply those convictions and points in the market can change. We have got a little bit of value tilt towards a lot of our portfolios, which have been out of favour for some time. And, clearly, big tech and healthcare was, obviously should be featuring more prominently in the portfolio, as if it was a no-brainer, lay down the Zare. And then, like that, we see that those conditions change really quickly. So to the earlier point about diversification, I think it is a good time to reflect on just how maybe overconfident people can get around some of these sectors and parts of the market which are in vogue at any given time. I think we should all reflect on the last couple of years with a bit of humility and just be honest about how difficult it is to be able to predict what's going to happen in the short term. It's extremely hard.
I think that's a really fair point to say, and I think luckily later on we're going to talk into a bit more of why megatrends are there and what they how they're perceived, I guess, towards the investment market. Luis, I might throw this back over your way, but of course, look, selection process with a manager, especially in an active environment, is the make or break. It's where you get your credibility, and it's how you find out what's going to be the best scenario for advisors and their clients. How do you become credible and skilled within that space?
Yeah, so that's exactly what the Professional Series is about. It's about understanding and bringing to Australian investors and giving them access to top tier managers. So yeah, we look very closely at how the manager thinks about investing, and how true to label they are over time. So importantly, all our managers are always fully invested, so they don't try to time cash. They don't try to your point about asset allocation. So when you're investing in our managers, you're in the market. You're not potentially going to allocate a lot of your portfolio to cash. We think that's very difficult to do, and we think that it can be risky because if you miss the turn, it's not just about getting out at the right time before the market crashes. It's also about getting in when the market. We saw that it only took 3 weeks through COVID for the market to then change direction very quickly. So you might get out at the right time, but then are you getting in at the right time? So all our managers are always fully invested. They're all active, as I said before. We try to stay away from the speculative end. So we try to offer a more sort of risk-adjusted outperformance over time. Most of our managers are bottom-up stock pickers. So yeah, you might need to be patient through different cycles for that outperformance to come through. But we do have a manager that is actually very tactical. He's a quant manager that actually tries to change, tries to predict where the market is going and tries to allocate to the right countries and the right sectors at the right time. Now that's very, very hard to do. But at least it's not like the cash decision, because the cash decision only gets tested every 5 years. So it's very hard to differentiate between luck and skill. You might do it once, or you're going to do it in 5 years' time. It's very hard to say. But when you're looking at sector rotations, and like you say, particularly since COVID, you actually get tested a lot more often. So you can sort of find a manager that has a bit of a track record of doing that more consistently. Now, obviously, they're not always going to get it right, but they get it right often enough.
I think choosing a manager based on how they invest and understanding how they invest is important. So, you said being a manager which is true to label, they consistently invest as they said that they would invest. Style drift has happened with managers previously, and you're very conscious of when a value manager has turned to a growth manager, for example, or a core, and you should be aware of, here's style drift happening in real time where a Aussie equity manager now has become too big and now wants to do international equities. That's style drift.
And I think you're right, yes, and especially like with someone like the value manager. Value has had headwinds for a very long time. So it's very refreshing when you go back and visit them and have a conversation and you talk about the portfolio, and they actually, they're so passionate and they know every single stock that is sitting in there and they know why they're holding it. And they recognize, yes, it's not our time yet, but there is value in those stocks and we're confident. So to your point you don't want to see that style drift, but I think it's even nicer when you see that conviction not being eroded over time.
Yeah. And also access to the manager and transparency with the manager is important because, there will be a time eventually where the fund underperforms. You want to be able to have a direct access to the fund manager and say, okay, well, let's just have a chat about performance. And if it's underperforming for a specific reason, you understand it, you might actually double down. It's actually become more attractive. It's not a reason to sell. So having access to the manager and transparency is important.
I think that's a really fair point as well, Carlo, because I think in a fragmented world that we've had since COVID, it's about that transparency, but also the connection that not just advisors have with their clients, but vice versa for the industry of fund managers as well. I'm going to jump into the next section here, which I think as well comes back to that selection process. So there's growth, value, and consideration towards those two, and quality. Different managers have different play styles. I think really, what would you say in today's market is the most, I wouldn't say beneficial, but one that's more prevalent in conversations today between growth, value, and quality?
We typically, within our international equities, we've preferred being diversified rather than having one style, because at any one point, growth has had a very good run for the past 12 years. Preference has been to have a diversified style. And I think that makes sense in international equities. It's hard to have a single style which will outperform consistently forever. I think that's very difficult. So,
yeah, I mean, we've got exposure to all three of those in our global equity mix. We've been overweight growth for a long time, not quite 12 years, but probably 10. You also got to remember the Australian equity market is very much value tilted. So, and all Australian portfolios have a lot of Aussie equities in them. So you probably want to have a little bit more into growth. So that's been good up until, 18 months ago. We pared it back a little bit. I think maybe you can be forgiven for not seeing the snapback in the last 6 or 7 months. I think one of the main reasons that's happened is because central banks around the world got inflation so horribly wrong. One of the worst forecast misses I think that we will ever see. And as a result, I think that's led a lot of the rotation from growth to value this time around anyway. So, but over 12 years, it's been good. And yeah, you want to have a bit of quality, a bit of value, and a bit of growth. You probably also want to have style neutral managers in there that will. I don't understand why fund managers shouldn't be expected, as we are, to decide whether growth or value is better and to move their portfolios around. They're probably better placed to do that than asset allocators potentially. So you want to have a good mix, I think.
So we have one of those managers that tries to time it right, and actually, since the start of the year, they've been calling value. They were saying their value signal was the strongest they've ever seen in the models when they run it back into history. So, and they got that call right. We've seen in the current environment, obviously, value outperforming growth significantly. It's been a while since that happened. It did happen a little bit when the vaccines were announced, but that was pretty short-lived. This one has been longer and potentially stronger. Now, So that's been interesting. So we like watching that manager because we like to see how the views change over time. The other one is if you think about inflation, and inflation being the very different thing. I think that's what really gives quality a leg up. Because if you are a company, I mean, the inflation, global equities is a good place to be in inflation. Obviously, inflation is not healthy across the board. It's also not healthy for equities. But companies that are quality companies have a better chance of being able to pass on any cost increases. You have a large margin, profit margin, because you're a quality company. You're going to be able to pass on a bit and maybe absorb a bit, but you're going to be able to get through that difficult period. Versus somebody who has a very narrow profit margin is going to be a much more difficult situation. And the same thing on the balance sheet, right? So if you've got a lot of gearing on the balance sheet, rising rates are going to impact you a lot more, and inflation is sort of pushing those rates up. So we sort of have seen quality outperform over the last 6 months, and sort of the outlook is looking also good for a quality tilt.
I think you made a really good point as well, Eugene, around the calls on inflation and how they have been kind of not necessarily misguided, but completely missed completely in some aspects. And this is also, in the last 10 years, having that growth aspect has been a really valid play. Do you think because there is uncertainty in the market, particularly with where people make calls, that value might be more of a play for the future?
Yeah, it's a good question, and it's one that we debate in our investment committee. So, what's priced into markets? We know interest rates are going up. I think that's probably the only thing that's priced into markets. What's probably not priced in is earnings revisions that are being revised down over the next few months, and possibly defaults as a result of rates rising and a recession. I don't know if that's in there yet. So what happens in a recession and what happens when you have earnings revisions, which companies are more likely? Quality companies, growth companies are possibly more likely to weather that storm a little bit better. We've already had quite a violent rotation. So is there much more of that to come? I don't know. I'd say if you've been good enough to pick the value rotation out of growth and you've got a very high conviction on that, you might want to pile that back a little bit. If you haven't, then it's probably a more difficult decision. But I'd say a lot of it's played out. Because remember, I think a lot of what has driven the last 6 or 7 months is the risk-free rate changing, going from 0 to 3, 4, 5%. Who knows exactly what it is, and that's really hurt growth stocks and even quality stocks to some extent. So I don't know. It's a difficult question, but
it's tough.
Whereas 6 months ago you would have had a very high conviction, and there was a very big gap. Same could have been said about going overweight Aussie equities compared to global equities. Now I'd say a lot of that has probably normalised a bit, and you want to start looking at more closely at sectors, more closely at stocks. So I don't know if there's that much value to go from here.
I don't know. I think we've got a different view. We'd have a view that with $1 trillion traded throughout last calendar year, to scratch our chin about what is or isn't priced into markets is a really tall ask. Sure, we can have different ideas about what could play out, but I think a lot of that comes about as a result of new facts that change rather than things that could have been predicted. It's very easy and very tempting to draw the narratives that have taken place over the last few or any period of time, really. But I think it's a mistake to then go and use that as a basis of strategy as to how you should position portfolios going forward. Or at least if you're going to, you need to do it with a big dose of salt, knowing that we really don't know whether the market's prices it in as well as it could or not, or if some new bit of information or new change of course is going to come along, which genuinely means things should take a different path.
I would agree with that. I mean, but it doesn't mean you can't have a view.
Sure.
Yeah, and I would also point out that I think markets are saying that you're still going to have a significant amount of earnings growth this year. So if who knows? Maybe companies will still have that earnings growth, but most of what I'm reading suggests that they're unlikely to. So until that becomes a bit like interest rates. Late last year, central banks were still mid to late last year, central banks were still saying particularly in Australia, rates aren't going to rise till 2024 in
February,
Australia.
Governor Philip Lowe.
Yeah.
You know, like it's just, and then look at what's happened now. So, if you think that we are going into a recession, I know a lot of mainstream fund managers are changing their base cases for a recession happening probably next year. Many aren't as well. So it just depends, you know. But you're right. Like you want to be positioned for everything, but to be able to have tilts, unless your view is we never take any views. We just have a set amount in each asset class and we leave it there forever. I guess the only way you can make any changes is to form a view something.
Yeah.
It makes sense to me that it's always hard to come up with a view because the market is so efficient. So, you know, as active managers, you know, believe the market there is an efficiency in there, but that doesn't mean the market is not super efficient as well.
Of course.
So it makes it very hard to take those views. I think that's also why many managers sort of, you know, we talk about sort of clients, helping clients get rid of the noise. You know, I think the bottom-up stock pickers, they also sort of have this view that, well, there's a lot of uncertainty and noise that we can ignore, but we just focus on really learning and knowing the companies that we select. And as long as we're picking, you know, better than average companies, and we have a belief that these companies are going to grow, or a belief that these companies are undervalued, it's a good reason for us to pick the company. We can ignore all that noise, and over the long term, that value should actually be sort of appreciated by the market. So yeah, even sort of experienced fund managers, you know, de-scope a lot of that discussion around macro and where macro is going.
Fair points, everyone. I'm going to move into the last segment as well, into this conversation, and it's challenges and opportunities. Now, everyone out there, particularly the listener, loves a bit of an outlook. We don't want to go too crazy into the crystal ball, so let's keep it balanced on this place. However, given the current turmoil, looking past that, how do we see global equities as an asset class as of today?
An opportunity. If you're owning global equities this time last year, you're buying them now at a discount. And as Australian investors, our market represents 2% of total equities. And as Eugene mentioned earlier, it's mainly in value, resources and banks. To get access to other sectors, you need to look to global equities.
I think most advisors these days will have global equities in their portfolios. There's still some that don't, and I think for good reason. All of those reasons, I don't think I can add much to that, but there's sectors you can't access unless you go into global equities. You can't access them well. So no, I think you have to have them in there for a variety of reasons. The other thing is that I would say is if global equities tank, it's unlikely that Aussie equities don't do poorly as well. Whereas if Aussie equities have a bad year, it doesn't really influence global equities. So yes, there's risks. Of course there's risks. But if you're going to be in equities, I would say, you probably should have some global in there.
I think global is important also. You've got certainly a lot more sectors to choose from, as you mentioned, like technology, you don't have as much here locally versus what you have offshore. But also the currency can help in addition. So normally in a recession, the Aussie dollar doesn't perform as well as offshore currencies like US, and that can provide some level of protection also.
Yeah, we'd say it's essential, absolutely essential. The Australian market, being only 2%, like you say, is way too narrow for a well-diversified investor. There's too many important drivers of the economy that you miss out on by staying domestic. So for some of our clients, we've got up to 70% of the equity allocation going to global at this point.
And I think I mentioned before, we think global equity is a good place to be in inflationary times, especially relative to other asset classes. So obviously, if you're sitting in cash and there's inflation, you're hurting. So I know yields in fixed income are better now, and that's a good thing. But also, if you look at the history and in terms of how global equities have done during high inflation environments, you'll find it's pretty good.
Interesting points. I think also what we discussed, very early on was the megatrends conversation. I actually have to look at this sheet because there's so many different types of megatrends out there. And to that point, is there a trend is a trend until the end, or trend is your friend until the end, rather? Is there something where you would navigate certain types of trends, and we'll break them down into technological disruption across industries that can include industrial automation, industrial automation, digitization. You also have personalized medicine. And then also you have sustainable investing, something which has been really apparent for a lot of the clients out there and advisors in their conversations. That includes things like the energy transition, biodiversity, and then of course, going on that, you have demographics. Now, these can go into an aging population, urbanization, and or globalization. So, of course, look, a lot of trends out there. Let's break it down, not necessarily by one, but as a whole. Are the trends something which we're seeing more of a phase in the moment of the market? Is it something where these are going to be the absolute go-tos in terms of how they navigate through past what we're currently experiencing?
This is what I really like about global equities. You know, you talking about the news and always talking about what's the worst thing that happened yesterday. I think when you look at global equities and you look at these trends, you know, you can have a lot of optimism. There's a lot of very impressive technologies that are being developed. Pretty impressive that we have a vaccine 11 months after the pandemic starts. And also COVID has accelerated many of these trends. So if you think about medicine and personalized medicine, now we've tested this vaccine technology that can be used for cancer, for example. Some of our managers, when you talk to them and we talk about these longer term trends, they're looking for companies that are aligned to those secular uplifts and they can benefit from those. So I guess you touch on ESG and you touch on energy transition. Often people can see ESG as a constraint in terms of the investment opportunity, but we have a manager that is very ESG focused and they actually see them as aligned. They're actually looking for opportunities that arise from solving those big problems like decarbonizing energy and investing in those companies that are offering solutions. So there is a lot of good things to talk about and optimism to have for the future when you look at a lot of those trends in global equities.
Yeah.
I agree. I think technology is such a huge, broad swathe of, here you have chips, here you have healthcare, here you have, there's just platform technology that is going to continue accelerating, I think. And within international equities, there's so much exposure to different forms of technology. I think that's going to continue accelerating. And in terms of ESG, that's almost widely adopted by all fund managers now. It's almost a requirement that you need to have an ESG policy. You need to have understanding of what makes an investment. Why can you not invest in a certain company? There's already filters for most, if not all the managers that I've seen anyway, how they choose stocks.
All right, I think we're going to wrap it up here, everyone. But thank you once again for your robust opinions, your discussions. I just wanted to say thank you to all of you on the table for being part of this discussion as well. So thank you very much.
Thank you.
Thank you.
And to you, the viewer, thank you very much for tuning in. Of course, we have lots of different conversation points to talk about here. You can find more information in the links below. And thank you once again for tuning in. Get in touch with us directly, which is at editor@ifa.com.au. And until then, thank you very much for tuning in. We'll see you in the next one.